right, well, let's find out where your conviction lies. We're going to dip into pro picks now. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Your first pro pick, and I'm so glad you brought this because I have a lot of questions. It's on Alphabet, which seems like such a safe tech play. But I am so deeply involved with ChatGPT now that I am wondering if this safe tech play is actually super vulnerable to generative AI in a way that maybe wasn't immediately clear when ChatGPT first came out.
So I'm not a technology expert. And so I'm going to say, I don't know if over the long term they are vulnerable. What I do know is that technology has evolved for the last 25 years, and Google or Alphabet has not been at the backseat of the bus. They've been driving the bus. They are at the forefront of what is going on. And I would like to believe that their Gemini AI system is going to still drive what brings in, for now, the most amount of money, which is search. Secondly, I have used ChatGPT, and I have used some other LLM models, and I must say that they're not, for search purposes, necessarily as good or as quick as what I will use when I just go into my Google browser.
Really?
And yeah, they're not, it depends on the case, but they're not as good as I thought they would be. So I don't think that overnight people are just going to start using ChatGPT for their search queries. And, when you look at Alphabet, this is like a mini conglomerate, right? I mean, you've got YouTube, you've got Waymo, you've got Willow, which hopefully, I don't know when it comes out, but that could be a game changer for them. You've got their cloud infrastructure business. They're investing more in their AI infrastructure business as we speak. You've got their Google Docs, which my kids use. I don't use, but the kids, they're on the Google Cloud. So I think that there's a big fortress moat around this business for the time being. And I think it's going to give them time to figure out how to maintain a certain piece of that moat.
Willow, for those who aren't familiar, it's a quantum chip that they're developing. Quantum was hot for a hot minute. But, the promise maybe is 10, 20 years plus away. The other sort of cloud over Alphabet is regulatory and whether or not the company gets broken up. And I've heard a lot of people say, like, so what?
Yeah.
What are you in that camp? So
Absolutely.
What if it gets broken up?
Absolutely. In fact, a lot of times conglomerates have the conglomerate discount in their stock prices. And perhaps if you broke out some of the pieces of the pie, it may get a very supersized valuation because people get excited about the future of that one component.
Let's talk where you fair value, where you think Google should be trading. It's around 150 right now.
I would say 195 to 210, somewhere in there, is
getting back
probably
just a few months ago.
Yeah, exactly.
Okay, your second company is interesting. It is Air Lease, and actually had really great earnings this week. It popped. Talk to me about what the business is and why you find it attractive.
So it's a very simple business. They lease aircraft to airliners. So they're typical, sort of like a bank, if you will, a lessor, right? They lease equipment, and it's longer term leases, and the equipment is very expensive. And because they have such an amazing relationship with basically an oligopoly, which is Airbus and Boeing, they have locked up their new inventory for, the next 5 or 6 years. So even if you're an airliner and you'd like to call Boeing and say, hey, I'd like to buy that plane, they may say, sorry, we don't have the capacity, because companies like Air Lease have already paid for orders and locked up contracts in advance. And a lot of times airliners don't want to buy their aircraft. They want to lease it.
So a slowdown in air travel does what to an air lease? Nothing.
Well, I don't want to say nothing, but generally speaking, airliners, well, it's like your car, whether your car sits on your driveway or whether you're driving to work, unless you want to give up the car, you're going to pay the lease. So it's a piece of equipment that they have to pay their lease on. If they don't pay their lease, Air Lease is going to repossess the equipment. I would like to believe that airliners, when they take on a lease of 5 or 10 years, it's because they want that newer piece of equipment that's fresher, newer, more fuel efficient, and will allow them to continue running their business.
The question I have is on upside. It seems like around $51, $52 per share, Air Lease taps out. At least it's done that over the last couple of years. It's broken slightly above that. Now it's at 53. Do you think that's a breakout?
So today, by buying the stock at $52, $53, you're not only buying it at well below book value, and this is recent book value, but you're buying an enterprise that has guaranteed lease payments coming to it over the next 5 or 10 years, and the profitability that goes along with it.
Does that book value, does that gap, has that always been the case, or is this kind of a newish phenomenon? Like the book value has steadily increased over 5 years, even as the stock has tapped out at that same level.
Yeah, so I think that over the last 2-3 years, that's been a sort of bigger phenomenon, because of the aftermath of COVID and the supply chain issues and what's going on. And also, of course, don't forget that when interest rates went from 0 to 5.5 or wherever they tapped out at in the US market, a company like this, which has, $20 billion of debt, right? The market could get worried that their cost of funding may go up a lot. If you believe, as we do, that markets rates have probably peaked and are probably going to come down, there's actually a potentially huge opportunity for Air Lease to refinance some of their debt and maybe over time get their average interest rate cost down, which really would fall straight to the bottom line.
Let's get your third pick, Lincoln National, kind of a financial services, kind of smaller cap too,
Yep.
And a little bit more beaten up. How do you see this one unfolding?
So Lincoln is a life co. They do asset management, they do retirement services, annuities, life insurance. We love the life insurance business. It's a very steady cash flow generation business. What I particularly like about life insurance is that if somebody stops paying their premiums, the liability on the company's balance sheet disappears because the policy lapses. And so all of the premiums that they received and had to reserve for the eventual death or disability or whatever just goes away. Now, obviously that lowers the revenues, but it also lowers the liability, and it all falls into, retained earnings, let's say. So when you're buying a company, when you look at the balance sheet of this company in Q4 of 24, the stated book value per the company was somewhere in the $72 range. Okay. Now, there's a lot of...
It's trading at 33, just for perspective.
It's trading at 33, right? Now, there's a lot of reasons why book value fell, having to do with their investment book and how interest rates went up. And so their bond prices went down. And so they had to remark and all of that stuff. And then there was a remarking on some of the costs of their policies and whatnot. But
so that was back in 2022, right?
Yeah, 2022,
yeah, because it was like a big drop in the stock.
It was a huge drop, right? But now that we are where we are, and you also had a turnover of management, right? But here are the positives. You get a pretty decent dividend. You have a pretty good earning stream. I think they're going to earn roughly $7.50, maybe $8 a share over the next year, and growing from there. You've got a lot of free cash flow, and their RBC, which is their risk-based capital, is, I believe, somewhere in the 420 to 430% range, which is very high. And so they have the capacity to keep on buying stock. And when you buy back stock at such a fraction of your book value, it becomes very accretive. Now, they did pause buybacks for a while because they wanted to rebuild capital and there was a change in the CEO. But I have a feeling that any day now, they're going to be able to relaunch massive amounts of buybacks. And I think that's going to be extremely accretive.
So it sounds like it was a really messy story for a while, but you think it's gotten cleaned up and about to get way better.
Absolutely.
Mike, thanks so much for joining me. What a great conversation.